There are few things we like more around here than a good spin-off. Often you'll find companies with a bunch of different businesses really don't belong under the same roof. Companies where the sum of the parts is actually worth more than the whole. In that case, spinning off one of the disparate divisions as an independent company can often make you a killing. Take the company formerly known as Manitowoc Food Service. That's a maker of kitchen equipment for the restaurant industry, which just rebranded itself right now as Welbilt and will trade under the symbol WBT. This company used to be part of Manitowoc, a machinery maker that mostly sells cranes. So the kitchen equipment business was constantly being ignored, I think both by management and by investors who are focused on the core crane division. That is until roughly a year ago when the company now known as Welbilt was spun off. Since then, it's rallied roughly 40%. And given that it reported a strong quarter in mid-February, I wouldn't be surprised it got more room to run. So let's dig deeper with Hubertus Mühlhauser. He's the president and CEO of Welbilt. To learn more about how his company's doing, where it's headed, Mr. Mühlhauser, welcome to Mad Money. Good to see you, sir.
Hey, hi, Jim. Thanks for having me.
Have a seat. Thank you.
Thank you.
Well, first, why the rename to Welbilt?
I think it was a back-to-the-future strategy. I mean, we wanted to cut off the last tie to the Manitowoc company, and Welbilt actually was the leader in our industry in the last century. It was founded in 1929 by the Hirsch brothers, and they consolidated the industry. So there is a lot of brand equity with Welbilt, and it resembles what we are. We are in the heart of the kitchen, and Welbilt is in the heart of the kitchen, so it was a natural.
Well, it's funny. I was reading over your conference call for the Barclays, Feb 22nd, and I was saying, oh, geez, I hope they didn't mind some of the things that I was saying about the company. And here we go. You said that, again, we don't want to talk badly about prior management, but it was so obvious that this food service business had no home in a crane company, and senior leadership never really appreciated the food service space. The business was underfunded and undermanned, wasn't it?
Yeah. I think it was two very different cultures. I mean, the crane business tends to be long-term oriented, right, backlog oriented, heavy machinery. And the food service business is a fast business, fast-moving consumer good business type of culture. So these two cultures never went together. Plus, the business, of course, had overcapacity. That was never addressed. We addressed that. The business had complexity. So business simplification, that's what we're addressing right now, very successfully, though. And I think the 330 basis point improvements in EBITDA that we achieved in the first year are testament of, I think, a renewed energy around Welbilt.
Now, Welbilt has some debt, and you just refinanced debt. Yeah. What does that mean for people who own the shares?
Well, I think it's very positive. First of all, we refinanced $825 million of Term Loan B. We got the biggest reduction of all bonds that were repricing since November, so 170 basis point reduction down to 300 basis point plus a 1% floor. And obviously, that's positive because we're going to pay less interest, and that's going to be positive for the EPS, so shareholders are going to love it. We like it.
All right. Now, you're up against some difficult competitors. We happen to like ITW very much. Middleby is a smaller cap company we don't talk much about, but they're very powerful. How do you differentiate?
Well, I think the main differentiation that we have is our long-term strategy. We are the only full-line equipment provider in a kitchen. So we have the full hot line, cold line, and beverages. And if you see the buying patterns for these large QSRs, the fast food restaurants, they want to buy from companies that understand their entire kitchen, the system of the kitchen. So we're moving from selling appliances to selling entire solutions and kitchen solutions. And we have that. We are that company. Plus, we have an integrated R&D backbone. And that sets us apart from most of our competitors.
Now, a lot of the big problems with when you really have a business, it's a high-quality problem, but it is a real problem, is throughput. You have a lot of technology in your different machines. Is it helping throughput? Are people looking to you for help in throughput?
Absolutely. I mean, people are looking, first of all, cost side. I mean, we help them reduce energy costs. Space. Kitchens get smaller and smaller. We help them to reduce labor costs. And of course, we help them on the output side. So when you basically get a well-built kitchen with all our equipment in there, you have paybacks that are sometimes less than a year. And that's basically what our customers are asking for, and that's what we can offer them.
Now, you have the customer list is incredible. So Burger King, Dairy Queen, Cracker Barrel, Chipotle, KFC, McDonald's, but we have Domino's on. You do work with Domino's?
Absolutely. They're a good customer of ours.
And at any given point in the structure, I mean, do you have any of these all? Do you have the whole soup to nuts for anybody, or is it just you have a piece of the Domino's business?
Honestly, no. On the professional business side, we have them all.
Really?
We have a nice balanced portfolio. 50% of our business is with the large fast food chains, the QSRs, and 50% is with the general market. The Daniel Boulud's fine dining, and the restaurant around the corner served by the general market. So we're happy to have both of these business areas.
And how important is that aftermarket business? Because I know you assemble the parts, but I would think that the idea that if something breaks, you're there, that's a good business to be in.
It's a very good business. We focus on the aftermarket parts.
Right.
And our dealers, we have more than 3,000 dealers around the globe, they service the machines with our original parts. And that's a very, very good business for us and our dealers.
Well, terrific. I think I'm so glad you split off. I really am, because I love your core business. It's fantastic. Okay, that's Hubertus Mühlhauser, the president and CEO of Welbilt, which is the old Manitowoc Food Services, which was part of the old Manitowoc. This is a much better company. And even though I know quick service had some little bit of slowdown, the guys with the best technology will win. Mad Money's back after the break. Booyah! Jim Cramer here from Mad Money. Thanks for watching CNBC on YouTube. Click here to subscribe and get the jump on my exclusives with CEOs, plus market news, investing advice, and a whole lot more.